All right, today we're jumping into a really fascinating investment strategy. We're looking at the Helios Arbitrage Fund and how it aims to capture profits by focusing on something called the spread, basically taking a lot of the stress out of watching the markets.
So let's start with the big question, right? So much of investing feels like trying to guess what's coming next. Will the market go up or will it go down? But what if there was a way to generate returns that didn't depend on you getting that guess right?
And this image pretty much nails the core idea. Think of it like this. Arbitrage funds try to operate inside a kind of protective bubble. They're focused only on that price difference, the spread, for the exact same thing in two different places. The whole goal is to capture that gap, no matter what kind of storm is raging in the wider market.
Okay, so let's really dig into what that means. How do you actually capture what seems like just a tiny crack in the financial system? Well, it all starts with a simple but really powerful idea.
At its heart, arbitrage is all about taking advantage of these tiny, temporary pricing mistakes between different markets. Like the cash market, where you buy a stock right now, and the futures market, where you agree on a price for a later date. You're not betting on whether a company is going to do great or poorly. Nope. You're just acting on a price difference that exists right now. The key takeaway is, it's a strategy based on how markets work, not on predicting where they're going.
So that's the theory. But how does a fund like Helios actually turn this idea into a real, repeatable process? It really just boils down to three key steps.
First, the fund systems spot a gap. Let's say a stock is $100 in the cash market, but its futures contract for next month is $101. Step 2, and this is the crucial part, it locks in the trade instantly. It buys the stock for $100 and sells that futures contract for $101 all at the same time. And third, well, then it's a waiting game. When that futures contract expires, those two prices are designed to meet, and that initial $1 spread becomes the profit. And that right there, that's the magic of it. The profit was, in theory, locked in the second the trade was made. It doesn't matter if the stock's price went to the moon or fell through the floor in the meantime. That doesn't affect the outcome of this specific trade. The fund's return comes from that spread it captured right at the beginning.
Now, understanding the concept of arbitrage is one thing, but execution is where it all happens. So let's look at what the Helios Arbitrage Fund specifically brings to the table.
First things first, a little context. The Helios Group isn't exactly new to this. They've been around since 2005, which means they bring a ton of experience and history to their investment approach.
Now this is where it gets really interesting, how they set themselves apart. It's a three-part strategy. Rigorous screening means they aren't just chasing every little gap. They're very picky, only going after high-probability trades. They are technology-driven, using smart algorithms to spot and act on these tiny opportunities in real time. That speed is a massive advantage. And finally, diversification. They don't put all their eggs in one basket. They spread their trades out across different sectors to keep risk in check.
And speaking of risk, which, let's be honest, is the first thing any smart investor looks at, Helios is super transparent about how they handle it. For them, protecting capital is priority number one.
I mean, check out this quote directly from their own documents. It sets the expectation perfectly. This fund isn't trying to be some high-flying, super risky thing. Its entire DNA is designed to be a lower-risk alternative built for consistency.
And it's not just them saying it. Here's the official rating to back it up. The fund is officially rated low risk, and so is the benchmark it's measured against. This gives you a really clear, standardized look at the kind of risk you should expect. It's all about being upfront.
Now, this slide is so important because it shows they're not just hoping for the best. They have a specific plan for specific risks. For general market risk, they use derivatives to hedge. To handle liquidity risk, the danger of not being able to sell something quickly, they make sure their assets and liabilities are properly matched. And as we just mentioned, they tackle concentration risk head-on by diversifying.
So, when you put it all together, this strategy of low volatility and active risk management, who is this actually for? Let's figure out if it might be the right fit for you.
Well, the ideal investor profile is pretty clear. If you're someone who wants returns but you really can't stand those wild market swings, this could be a good fit. It's also aimed at people who might have some cash sitting around for the short term and want a tax-efficient option. Or, for more conservative investors who just want their money to work a bit harder for them than it would in a plain vanilla savings account.
So if you had to boil it all down to just one sentence, what's the goal here? It's about trying to generate income with low volatility. It's not about hitting home runs, it's about consistently getting on base, which could make it a really solid piece of a short to medium-term portfolio. And that brings us to the final big idea here. The whole philosophy behind the Helios Arbitrage Fund is that you don't have to predict the future to be successful. Maybe the smarter play isn't trying to outguess every twist and turn of the market, but instead to find and capture those small, consistent opportunities hidden in the way the market itself is built.